On January 1st, 2026, the global financial landscape shifted beneath the feet of every major industrial power, yet almost no one heard the sound of the trap closing. While the world was celebrating the new year, a silent countdown reached zero in Beijing and New York simultaneously. For decades, silver was treated as the forgotten stepchild of gold, a mere byproduct of lead and zinc mining, or a speculative play for retail investors. But as of this morning, silver has officially transitioned from a decorative luxury to the most potent economic weapon of the 21st century. We are no longer talking about price charts or technical analysis. We are talking about a mathematical checkmate. Let me show you the numbers that make this situation inescapable. Right now, as you watch this, a single institution, JP Morgan, sits on a hoard of 750 million ounces of physical silver. To understand the gravity of that figure, you must realize it represents 90% of the entire planet is annual mine production. Imagine one single bank, in a span of just 5 months, swallowing nearly every ounce of silver pulled from the earth across the globe. This is not just a position. It is a corner. While the official COMEX registered inventory, the silver supposedly available for immediate delivery, languishes at a mere 30 million ounces, JP Morgan controls 25 times that amount in private vaults, shielded from public scrutiny. This accumulation did not happen by accident. It was a masterpiece of strategic timing. As we move into the first quarter of 2026, the structural deficit in the silver market has reached a breaking point. Before the recent geopolitical shifts, the world was already facing a shortfall of 370 million ounces per year. But 4 days ago, the final pillar of the old market collapsed. China, the world's primary refiner and a critical exporter, officially implemented its restrictive export licensing system. This move effectively removes another 175 million ounces from Western access annually. The math is now brutal and undeniable. We are staring at a 545 million ounce annual deficit with no new supply coming online. In this environment, silver is no longer a commodity traded for profit. It has become the subject of a high-stakes hostage negotiation. On one side, you have the industrial titans, Apple, Tesla, and the massive solar energy conglomerates of Europe and North America. Their production lines require silver every single day. There is no substitute. On the other side, you have JP Morgan, the only entity on Earth with enough physical inventory to bridge the gap. As the sun rises on 2026, the question is no longer if silver will rise, but how much the world's largest manufacturers are willing to pay to prevent their billion-dollar production lines from grinding to a silent halt. The clock is ticking, the gates are closed, and the endgame has begun. To understand why the current situation is so explosive, we must look back at one of the most dramatic ideological shifts in financial history. For 17 years, JP Morgan was widely considered the primary antagonist of silver investors. This legendary saga began in March 2008 during the height of the global financial crisis. When JP Morgan acquired the failing investment bank Bear Stearns, they inherited more than just office buildings and staff. They inherited a massive toxic short position in silver futures, totaling approximately 200 million ounces. This was a bet that silver prices would stay low or even collapse. For nearly 2 decades, JP Morgan did not just maintain this position, they expanded it. Data compiled by the Commodity Futures Trading Commission consistently showed that this single bank was the dominant force suppressing prices on the COMEX. Year after year, silver advocates accused the bank of manipulation, leading to multiple federal investigations and billions of dollars in fines. But then, between June and October of 2025, something fundamental changed. The predator decided to become the protector. During a 5-month window, the commitment of traders' reports revealed a move that left the industry stunned. JP Morgan was not simply closing out their short positions to break even. They were aggressively flipping the script. They began accumulating massive long positions while simultaneously demanding physical delivery of every ounce they contracted. According to delivery reports from the Chicago Mercantile Exchange, the bank took delivery of approximately 150 million ounces of silver every single month for 5 consecutive months. Visualize the sheer scale of this operation. To move 150 million ounces of silver, you need roughly 300 standard industrial truckloads. Every month for 150 days straight, A continuous convoy of physical metal was being diverted from the public markets into private, high-security storage facilities controlled by the bank. By the end of October 2025, J.P. Morgan had completed a total position reversal of nearly 1 billion ounces when you factor in the closing of their shorts and the opening of their physical longs. How do we verify these staggering figures? We look at 3 independent data streams. First, the COMEX delivery receipts, which list J.P. Morgan as the primary recipient. Second, the quarterly derivatives report from the Bank for International Settlements, which showed the bank's net position in precious metals suddenly flipping from negative to massively positive for the first time since 2008. And third, vault data from precious metals research firms like Metals Focus, which confirmed a corresponding surge in private warehouse stocks. The era of J.P. Morgan suppressing silver is over. They have spent 17 years keeping the price low so they could eventually buy the entire market at a discount. They have successfully moved from being the short seller of last resort to the physical hoarder of first resort. They are no longer betting against silver. They are betting that the rest of the world will soon have to come to them, on their knees, to ask for the metal they spent 2 decades accumulating. While J.P. Morgan was vacuuming up the world as physical silver supply in New York and London, a much larger geopolitical chess move was being executed in Beijing. To understand the silver market of 2026, you must understand that China is no longer just a participant in the global economy. It is the gatekeeper of the Green Revolution. On October 30th, 2025, the Chinese Ministry of Commerce issued a memorandum that sent a chill through every Western boardroom. They announced a comprehensive export licensing system for silver and its related alloys effective January 1st, 2026. The timing of this announcement was a masterclass in economic warfare. China waited until Western industrial demand reached an all-time high, driven by the frantic expansion of solar energy and electric vehicle infrastructure. Then, they lowered the gate. The new regulations established a minimum export threshold of 80 tons per shipment, a requirement so high that it effectively locked out 180 of the 200 existing Chinese silver exporters. By consolidating the export power into the hands of a few state-sanctioned entities, Beijing gained total control over the flow of silver to the West. But why would China do this? The official reason cited national economic security and the protection of strategic resources. The real reason is far more calculated. China produces and refines a massive portion of the world is silver, but they have realized that shipping this metal to the United States and Europe is equivalent to exporting their own technological future. Every ounce of silver that leaves Chinese shores is an ounce that cannot be used in a Chinese-made AI chip or a Chinese solar panel. They are no longer willing to trade a finite critical resource for depreciating paper currency. The immediate impact on the market was a phenomenon known as the Shanghai Premium. By late December 2025, the price of silver in Shanghai was trading at $5 to $8 per ounce, higher than the price in London or New York. This price gap is a clear signal of physical scarcity. When the premium is that high, metal flows toward the higher price. But because of the new export restrictions, that flow has been cut off. The West is now an island of high demand with a rapidly receding tide of supply. The coordination between China's policy and J.P. Morgan's accumulation is the most disturbing aspect of this timeline. Reuters reported that Chinese officials were discussing these specific restrictions at mining conferences as early as June 2025. J.P. Morgan, with its extensive banking operations in Shanghai and Beijing and deep ties to Chinese refiners, was perfectly positioned to hear those whispers. While the average investor was watching mainstream news, the world's largest bank was acting on elite intelligence. China has essentially set the trap by removing the supply, and J.P. Morgan has provided the only exit by hoarding what is left. For the Western manufacturer, the January 1st deadline was not just a date on a calendar, it was the moment they lost their backup plan. There are no more open doors in the East, and the only door left in the West is the one controlled by a single bank on Wall Street. The trap is not just set, it has already snapped shut. To grasp the magnitude of the coming price explosion, we must step away from the noise of the news and look at the cold, hard mathematics of silver consumption versus production. Figures do not lie, and the current balance sheet for silver is a document of pure catastrophe for anyone who does not already own the physical metal. In 2025, total global mine production was approximately 830 million ounces. At first glance, that sounds like a massive number. However, when we look at the other side of the ledger, total industrial and investment demand for that same year reached a staggering 1,200 million ounces. This leaves us with a structural deficit of 370 million ounces before we even consider the impact of China. For years, the market managed to hide this gap by drawing down above-ground inventories and relying on silver recycling. But we have reached the limit of those buffers. Global silver recycling currently recovers only 180 million ounces per year. More importantly, recycling is a trailing indicator. You cannot recycle the silver inside a solar panel or a cruise missile until that product reaches the end of its life, which often takes 20 to 30 years. In a rapidly expanding market, recycling simply cannot keep pace with new demand. Now let us factor in the China lockdown. By removing an additional 175 million ounces from the global export market, China has expanded the annual shortfall to a massive 545 million ounces. This is where the math becomes truly brutal for Western technology companies. Every single year, the world now needs 500 million ounces more silver than the mines can produce and the recyclers can recover. Where will this silver come from? There are only two sources left. The first is the official exchange vaults, such as the COMEX and the London Bullion Market Association. As of late December 2025, the COMEX registered inventory has plummeted to just 30 million ounces. That is less than a single month's worth of current global industrial demand. The second source is the private hoard of JP Morgan. With 750 million ounces, JP Morgan is the only entity with the capacity to prevent a total industrial shutdown. But even the JP Morgan hoard has its limits. At the current deficit rate of 545 million ounces per year, the bank's entire vault would be drained in just 16 to 18 months if they tried to supply the whole market. And we know they will not do that. They are a bank, not a charity. They will likely release small amounts, perhaps 400 to 500 million ounces, over the next 2 years, and they will do so at a price that maximizes their 17-year investment. For a manufacturer, the calculation is even worse. It takes between 7 and 12 years to bring a new silver mine from discovery to full production. You cannot simply turn a dial and create more silver because the price went up. The supply is inelastic, meaning it cannot react quickly to price signals. We are heading into a period where the demand is infinite because the technology is essential, but the supply is finite and controlled by a single gatekeeper. When 545 million ounces of demand meets 30 million ounces of available supply, the only variable that can change is the price. And that change will not be incremental. It will be vertical. In the world of high technology, there is a list of materials that are considered critical, but none possess the unique profile of silver. To understand why companies like Tesla, Apple, and the giants of the solar industry are effectively hostages in this market, you must understand the physics of the metal itself. Silver is the most electrically conductive, thermally conductive, and reflective metal on the periodic table. In the race to build smaller chips, faster electric vehicles, and more efficient solar panels, silver is not just a component, it is the foundation. Take a company like First Solar or any major manufacturer of photovoltaic cells. According to the Solar Energy Industries Association, the solar sector alone consumed 320 million ounces of silver in 2025. That is nearly 40% of all mined silver. Each panel requires silver paste to conduct the electricity generated by sunlight. While engineers have tried to substitute silver with copper or aluminum, the loss in efficiency is catastrophic. A 5% drop in conductivity across a massive solar farm translates to millions of dollars in lost revenue over the life of the project. Now consider the position of a purchasing manager at Tesla. An average electric vehicle contains between 25 and 50 grams of silver, used in everything from battery management systems to autonomous driving sensors. While 50 grams might seem small, when you multiply that by millions of vehicles, the demand is relentless. Tesla cannot wait 7 years for a new mine to open. They cannot stop their production lines because a single sensor cannot be built. If Tesla stops producing cars, their stock price collapses, their contracts are breached, and their market share vanishes. This creates what economists call perfectly inelastic demand. In simple terms, it means these companies will pay almost any price to secure the physical metal because the cost of not having it is total operational failure. Let us look at the break-even math for a solar manufacturer. At $77 per ounce, silver represents about 7% of the total cost of a solar panel. If the price of silver doubles to $150, the total cost of the panel only increases by about 8 to 10%. This is annoying for their profit margins, but it is manageable. They can pass that cost to the utility companies or the end consumers. However, if they cannot get the silver at all, their revenue goes to zero. This is the leverage JP Morgan holds. They know that Apple needs silver for the billions of solder points in every iPhone and MacBook. They know that the AI revolution, which relies on massive data centers and high-performance semiconductors, consumed 90 million ounces of silver last year. These industries are the engines of the modern economy, and they are all running on a fuel that is currently being hoarded in private vaults. By mid-2026, as manufacturers exhaust their 90-day forward contracts, they will realize that the traditional suppliers in China are no longer responding. They will turn to the open market and find it empty. At that moment, the CEOs of these massive corporations will have to make a choice. They can either walk into the commodities desk at JP Morgan and ask for a price, or they can watch their factories go silent. JP Morgan is not selling an investment. They are selling a survival kit to the most powerful companies on Earth, and the price of that kit is about to reach levels that the world has never seen. Whenever the phrase cornering the silver market is mentioned in financial circles, the ghost of the Hunt brothers immediately haunts the conversation. To understand why JP Morgan's current position is so much more dangerous than the 1980 crisis, we must examine what truly happened to Nelson Bunker Hunt and his brother Herbert. In the late 1970s, the Hunts believed that the US dollar was heading for a total collapse due to rampant inflation. Their solution was simple: buy as much silver as possible. By January 1980, through a combination of physical metal and leveraged futures contracts, the Hunts and their Saudi partners controlled approximately 200 million ounces of silver. At the time, 200 million ounces was enough to drive the price from $6 to a peak of nearly $50 per ounce. But the Hunts made a fatal mistake that JP Morgan has carefully avoided. The Hunts built their empire on debt. They used massive amounts of leverage provided by the very banks and brokerage houses they were trading against. When the price of silver began to rise too high, threatening the solvency of the short sellers on the COMEX, the people who owned the emergency stop button decided to use it. On January 7th, 1980, the exchange changed the rules in the middle of the game. They introduced Silver Rule 7, which dramatically increased margin requirements and limited investors to holding no more than 10 million ounces in futures contracts. Essentially, they forced the Hunts to sell. When the Hunts could not meet a $100 million margin call on March 27th, a day forever known as Silver Thursday, the market collapsed, and the brothers were eventually forced into bankruptcy. Now look at JP Morgan in 2026. The scale is not just larger, it is on a different plane of existence. JP Morgan has accumulated 750 million ounces. That is 7.5 times the size of the Hunt brothers' hoard. But here's the critical difference. JP Morgan is not using leverage. They are the ones providing the leverage to everyone else. They are not borrowing money to buy silver. They are using their own massive balance sheet to take physical delivery. In 1980, the regulators stepped in because the Hunts were outsiders threatening the banking system. In 2026, the banking system itself is the one holding the silver. You cannot change the rules to break JP Morgan because JP Morgan, along with a few other primary dealers, effectively writes the rules of the COMEX. While the Hunts held paper contracts that could be canceled or liquidated by exchange decree, JP Morgan holds physical bars in private vaults. You cannot margin call a physical bar of silver that is already paid for and locked behind a steel door. The Hunt brothers were speculators. JP Morgan is a custodian. The Hunts were fighting the system. JP Morgan is the system. By moving 169 million ounces from deliverable to non-deliverable status in late 2025, the bank has already signaled that this metal is not for sale at current prices. They have successfully executed the corner that the Hunts could only dream of, and they have done it with the full knowledge that no regulator is coming to save the industrial buyers. The ghost of the Hunt brothers serves as a warning, but for JP Morgan, it served as a blueprint on how to do it right. For over 50 years, the price of silver has been determined not by the exchange of physical metal, but by the trading of paper contracts on the COMEX. In this system, for every 1 ounce of physical silver sitting in a vault, there are often 100 or even 500 ounces of paper silver being traded in the form of futures and derivatives. This massive leverage allowed large institutions to keep prices artificially low, as they could simply sell more paper contracts to overwhelm any increase in physical demand. But as we enter the first quarter of 2026, this game of musical chairs is coming to an end. The paper market is about to collide with physical reality. The first sign of this breakdown occurred in late December 2025. While the official spot price on the COMEX was quoted at $68 to $77, industrial buyers in Asia were already paying premiums of 20% or more to secure actual bars. This is the phenomenon of price decoupling. When physical metal becomes scarce, the paper price becomes a fiction. It represents the price of a contract that no one believes can be fulfilled with actual delivery. By the end of March 2026, we expect to see a total convergence. This is the moment when the paper price must rise to meet the physical price, or the exchange itself faces a default. According to supply chain analysts at McKinsey, most electronics and solar manufacturers operate on 60 to 90-day forward contracts. The orders they placed in October and November of last year are arriving now, but the orders they placed in December and January are not. As these corporations realize their March and April deliveries are missing, they will flood the COMEX with delivery notices. When 300 million ounces of delivery demands hit an exchange that only has 30 million ounces of registered inventory, the system breaks. Based on historical precedent from other commodity squeezes, such as the nickel squeeze on the London Metal Exchange, the price adjustment happens within a 30 to 45-day window. This adjustment is what will take silver to our first major target of $100 per ounce. At $100, the paper shorts will be wiped out. For every dollar the price rises, those holding short positions lose hundreds of millions of dollars. As they rush to buy back their positions to limit their losses, they create a massive wave of buying pressure, often called a short squeeze. This further accelerates the upward move. However, unlike previous squeezes, there will be no relief valve. Usually, higher prices entice more supply to enter the market. But with China's export gates locked and JP Morgan holding 90% of the year's production, there is no new supply to meet the panic. JP Morgan is now sitting on the other side of this trade. Having closed their 17-year short position in late 2025, they are no longer the ones being squeezed. Instead, they are the ones who will provide the liquidity at the top. They will watch as the paper market burns, waiting for the exact moment when the spot price reaches a level that reflects the true industrial scarcity. For the first time in modern history, the price of silver will not be what a trader in a suit says it is. It will be what a manufacturer with a shuttered factory is willing to pay to keep his business alive. That price is $100, and it is only the beginning. To understand why a price target of $300 is not only possible, but mathematically probable, we must examine the most important relationship in the history of money: the gold-silver ratio. This ratio represents how many ounces of silver it takes to purchase a single ounce of gold. For over 5,000 years of human civilization, from the Roman Empire to the founding of the United States, this ratio remained remarkably stable at approximately 15 to 1. This was not an arbitrary number. It reflected the natural occurrence of these metals in the Earth's crust and the relative cost of extracting them. In the modern era, however, this relationship has been violently distorted. As we sit here in late December 2025, gold is trading at approximately $4,500 per ounce. With silver at $77, the current ratio is roughly 65 to 1. This means silver is being valued at less than a quarter of its historical average relative to gold. But here is the critical insight. While gold is primarily a monetary asset stored in central bank vaults, silver is an industrial asset that is being consumed and destroyed. In 2026, we are witnessing a fundamental paradigm shift. Historically, silver followed gold. When gold went up, silver eventually followed. But in this new era of strategic resource competition, silver is beginning to lead. The industrial demand for silver in high-tech applications has created a situation where there is actually less investment-grade silver available above ground than there is gold. According to data from the Silver Institute, The amount of identifiable silver bullion stocks has been declining for 6 consecutive years, while gold stocks continue to grow through central bank accumulation. If the gold-silver ratio were to return to its historical average of 15 to 1, with gold at $4,500, the price of silver would need to reach $300 per ounce. Even a more conservative correction to 30 to 1 would put silver at $150. What makes this correction inevitable in 2026 is the shift in who is buying. For the last 20 years, the ratio was kept high by paper trading and institutional disinterest. But when industrial giants like Samsung or First Solar enter the market, they do not care about historical ratios. They care about physical units. When these companies face a choice between paying $150 per ounce for silver or shutting down a billion-dollar production facility, they will pay the $150. This industrial necessity acts as a gravitational pull, dragging the silver price toward its true value. Furthermore, as the price begins to move, we expect to see a massive rotation of capital. Global macro hedge funds, seeing the breakdown of the 65 to 1 ratio, will begin shorting gold and going long on silver to capture the narrowing gap. We are not just looking at a price increase. We are looking at the end of a 100-year anomaly. The distortion that began when silver was demonetized in the late 19th century is being corrected by the reality of the green energy revolution. Silver is finally being recognized for what it is, the indispensable metal of the modern age. As the ratio collapses from 65 toward 15, the gains in silver will outpace gold by a factor of 4. The math of the Earth's crust and the math of the factory floor are finally converging, and the result will be a price reset that redefines the global financial order. To navigate the coming volatility, you must stop looking at the market as a series of random events and start seeing it as a fixed sequence. The fuse has been lit, and the explosions will occur on a predictable schedule. We are currently in the final days of December 2025. This is the quiet before the storm. Let me walk you through the endgame timeline so you can recognize the signals before they become mainstream news. The first critical date is January 1st, 2026. This is the moment the Chinese export licensing system becomes fully operational. While the Western markets are closed for the holiday, the administrative machinery in Beijing will begin denying permits to non-sanctioned exporters. On January 2nd, as institutional traders return to their desks in London and New York, the first task will be to analyze the holiday news. The smart money will notice the lack of new export quotas from China and begin repositioning immediately. During the first 2 weeks of January, from the 6th to the 17th, the first cracks will appear in the industrial supply chain. Purchasing managers at mid-sized electronics firms in Europe and North America will start making their routine calls to Chinese refiners. They will be met with silence or polite notices stating that orders cannot be fulfilled due to new regulatory requirements. This is when the private panic begins. These companies, which typically operate on 30 to 45 days of physical inventory, will realize their buffer is evaporating. By the second week of February, we expect the first major distressed purchase. A large manufacturer, perhaps a solar cell producer in the United States, will be forced to go to the open market to secure an emergency shipment. They will not pay the spot price. They will pay a physical premium of 30 to 40% just to ensure their production line does not stop. Word of this transaction will leak through industry channels, and the race to secure supply will accelerate into a full-blown scramble. The month of March 2026 will be the period of total convergence. This is when the 90-day forward contracts signed in December will come due. As the COMEX exchange fails to deliver the required metal, the paper price will be forced into a vertical move to match the physical reality. This is our target for $100 per ounce. At this point, the financial media will finally start covering the story, but by then the opportunity to position at current levels will be long gone. By mid-year, June 2026, we enter the final phase, the negotiation with the gatekeeper. This is when the largest corporations on Earth, having exhausted all other options and backup suppliers, will have no choice but to negotiate directly with JP Morgan's commodities desk. The bank will not be selling in the open market. They will be conducting private placements at prices that reflect the absolute desperation of the buyers. This is the period where targets of $150 to $200 become the baseline. The timeline is fixed because the physics of mining and the laws of contract delivery cannot be cheated. You can print money, but you cannot print silver. Each milestone I have described is a mathematical necessity based on current inventory levels and consumption rates. Watch for the Shanghai premiums in January, the delivery failures in March, and the corporate earnings warnings in June. These are the receipts of a market in terminal collapse. We are entering a new epoch of economic history, one where the digital abstractions of the last few decades are being violently reconnected to the physical reality of the earth. For too long, the financial world operated under the illusion that you could simply print more wealth or substitute critical materials with clever accounting. But as we have seen throughout this analysis, the year 2026 marks the moment that illusion shatters. The silver market is not just experiencing a price spike, it is undergoing a fundamental re-rating as a strategic national security asset. The situation is now clear. China has used its dominance in refining and production to set a geopolitical trap, effectively cutting off the Western world from its most essential industrial fuel. At the same time, J.P. Morgan, the very institution that spent 17 years suppressing silver prices, has executed the largest physical accumulation in history. They saw the end of the paper market coming, and they positioned themselves to be the ultimate gatekeeper. Whether you are a retail investor or the CEO of a multi-billion-dollar technology firm, you are now operating in a world where J.P. Morgan and Beijing own the board, the pieces, and the clock. So, how do you navigate this new reality? First, you must stop listening to the mainstream financial media that continues to treat silver as a mere commodity or a volatile side play. The receipts are in the regulatory filings, the exchange delivery reports, and the export memorandums from the Chinese Ministry of Commerce. These are the only data points that matter. Second, understand that the window for positioning before the obvious becomes undeniable is closing. By the time the $100 price target is reached in March, the physical premiums and delivery delays will make it nearly impossible for the average person to acquire the metal. This is not a prediction. It is a description of a process that is already 60% complete. The mines are exhausted, the recycling is maxed out, and the industrial demand from solar, electric vehicles, and artificial intelligence is non-negotiable. We are watching the largest supply-demand imbalance in modern history unfold in slow motion. The only variable left is how quickly the rest of the world wakes up to what J.P. Morgan and China already know. As we move into the first quarter of 2026, the global economy is about to learn a very expensive lesson. You can live without a high stock price, and you can live without a strong currency, but you cannot run a 21st century civilization without silver. The math is fixed, the players are in place, and the game is already in checkmate. The only question left is, will you be part of the few who saw it coming, or the many who spent the rest of the decade explaining why they did not? Thank you for watching this deep dive into the silver endgame. If you found this logical analysis valuable, ensure you are subscribed for our upcoming reports on the gold ratio correction and the future of strategic resource competition. The era of paper is ending. The era of physical reality has arrived.